The allure of growth stocks, it's a powerful siren song, isn't it? The promise of exponential returns, of spotting the next market dominator before anyone else. We see the headlines, we hear the whispers of companies poised to redefine industries, and the instinct to chase that rapid ascent can be overwhelming. But beneath the shimmer of explosive potential often lies a landscape fraught with peril. For those of us who approach investing with a critical eye, a healthy skepticism, and a deep respect for capital preservation, this chase requires more than just enthusiasm. It demands a clear understanding of the very real dangers. Benjamin Graham, the father of value investing, taught us about the crucial concept of a margin of safety. It's that buffer, that cushion against error, against the unpredictable turns of the market and the inherent uncertainties of business. Chasing unproven growth without this essential margin is like building a magnificent structure on shifting sands. A slight economic tremor, a shift in consumer sentiment, or a misstep in execution can send it all tumbling down, leaving portfolios burned and aspirations dashed. This is why we must look beyond the dazzling narratives. We need to see the hidden costs, the behavioral biases that lure us into precarious positions, and the often illusory nature of valuations built on future dreams rather than present realities. Over the next few minutes, we will begin to unpack the common traps that ensnare even the most ambitious investors when they fall prey to the siren song of growth. Our aim is not to extinguish the pursuit of growth altogether, but to equip you with the discerning eye, the analytical rigor to distinguish between sustainable, robust expansion and a fleeting hype that too often leads to the rocks. We are here to protect your capital, to enable informed decisions, and to build wealth not on speculation, but on enduring value. The first trap we often fall into when chasing growth stocks is what we can call the greater fool valuation. This is where the price itself becomes the primary, and sometimes the only, metric that matters. The narrative takes over, the fear of missing out, or FOMO, becomes a driving force, and suddenly, fundamental valuation takes a back seat. We convince ourselves that because stock is going up, it must be a good investment, regardless of what the underlying business is actually worth. Think of it like a speculative bubble. The value isn't derived from the intrinsic worth of the asset, but from the deeply held belief that someone, somewhere, a greater fool, will come along and pay even more for it tomorrow. It's a dangerous game of musical chairs, and when the music stops, the consequences can be devastating. The price, which seems so robust, can collapse with astonishing speed, leaving investors holding assets worth far less than they paid. This is the hidden risk, the severe downside when market sentiment inevitably shifts, and that eagerly awaited greater fool simply isn't there. To protect yourself, you must implement a rigorous valuation framework, whether it's a discounted cash flow analysis, a careful comparable company analysis, or other methods. Always ground your decisions in conservative assumptions. Set clear sell triggers for yourself. If a stock's valuation expands so far beyond its intrinsic worth that it enters this greater fool territory, it's time to consider exiting, not doubling down. The price may be climbing, but if it's detached from the reality of the business, it's less an investment and more a speculative lottery ticket. And that's a gamble few prudent investors should take. A potent trap for growth stock chasers is the illusion of unstoppable momentum. It's the belief that because a company or an industry has been performing exceptionally well, this success will simply continue indefinitely. This extrapolation of past performance into the future breeds a dangerous overconfidence, blinding investors to the ever-present possibility of disruption and change. We become so enamored with the upward trajectory that we fail to see the cliff edge just ahead. Consider the classic tale of Blockbuster versus Netflix. For years, Blockbuster dominated the home entertainment landscape. Their growth seemed unstoppable. Yet, technological shifts and a new business model emerged, rendering their established dominance obsolete. The growth that seemed so permanent in one era evaporated in the next. This highlights a hidden truth. Many industries that appear to be perpetual growth engines are, in reality, cyclical or highly susceptible to disruptive innovation. Investors often miss the subtle, then not so subtle, signs of saturation, changing consumer preferences, or emerging competitive threats until the decline is already well underway. It's crucial to analyze industry life cycles, to actively seek out potential disruptors, and to assess a company's competitive mode not just based on its current market share, but on its resilience against evolving landscapes. And let's not underestimate the neuroemotional trigger at play here. The sheer exhilaration, the almost addictive dopamine hit from riding a powerfully rising stock, can create a strong psychological pull. This momentum addiction can make it incredibly difficult to exit a position, even when the warning signs are flashing red, because the feeling of being on a winning streak is so compelling. Recognizing this emotional siren is as vital as understanding the industry dynamics. A particularly insidious trap in growth stock chasing is what we can call the profitless prosperity paradox. This is where companies appear to be thriving, with their revenue figures soaring, but upon closer inspection, they are burning through cash at an alarming rate. often with no clear path to sustainable profitability. The focus is solely on the top line, the revenue growth, while the bottom line, the actual profit and cash generation, is neglected or even intentionally sacrificed. Imagine a lavish party where the host is spending fortunes on entertainment, food, and decorations, making the event seem incredibly successful. The guests are delighted, the atmosphere is electric, but the host is accumulating massive debt with each passing hour. Eventually, the party must end, and the host faces bankruptcy. Many growth companies operate in a similar fashion, prioritizing the appearance of growth over the fundamental health of their finances. They are essentially funded by external capital, be it through dilution of shares or accumulating debt, rather than by the inherent strength of their business operations. We must debunk the myth that growth for growth's sake is inherently good. True, sustainable growth should ideally lead to increasing profitability and robust free cash flow generation, not perpetual losses that require constant external funding. When examining these companies, pay close attention to metrics like free cash flow, return on invested capital, and the company's cash burn rate. Understand the company's realistic path to profitability, and crucially, when their profitability is expected to materialize. From a critical theory lens, we must persistently question the underlying business model and the true competitive advantage when a company consistently fails to translate its impressive revenue into actual profits. Without that, the prosperity is an illusion, and the portfolio is at grave risk. Another significant trap that ensnares growth stock chasers is what we can term the management overpromisitis syndrome. This trap is rooted in an overly optimistic, often uncritical, faith in the pronouncements and guidance issued by a company's leadership. We listen to the confident CEO, the detailed investor presentations, and we begin to believe implicitly in their ambitious projections, often without sufficient independent verification. Consider it akin to a magician's performance. The audience is mesmerized by the illusion of the impossible, the dazzling feats that seem to defy logic. But the real work, the sleight of hand, the potential misdirection, happens backstage, hidden from view. Similarly, management's promises about future growth can be captivating illusions. We are often not privy to the full operational realities, the internal challenges, or the true feasibility of their grand plans. Furthermore, we must be aware of hidden incentives. Executive compensation is frequently tied to hitting revenue targets or achieving certain stock prices, often through stock options. This structure can powerfully incentivize management to issue overly optimistic projections, even when they know deep down that these targets are highly ambitious, if not outright unrealistic. It creates a misalignment between the language spoken in earnings calls and the actual operational likelihood of success. To navigate this, it's crucial to scrutinize management's historical track record. Have they consistently hit their guidance? Analyze the language they use. Listen for hedging, vagueness, or a lack of concrete detail. Cross-reference their projections with realistic industry data and growth rates. The behavioral bias trap here is our tendency to be swayed by charismatic personalities or confident pronouncements, leading us to neglect the essential, independent due diligence required to assess the true feasibility of their ambitious plans. Faith is important, but in investing, it must be tempered with proof. We now turn our attention to trap number 5, the dilution dance. This is a subtle yet profoundly damaging trap for growth stock investors, one that can undermine even seemingly impressive stock price gains. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. For growth companies, which often require significant capital to fund their expansion, this is a common, almost expected practice. However, the impact on existing shareholders can be significant and often overlooked. Think of it like this: imagine you're at a party and you have a slice of a delicious pizza. As more people arrive, the host decides to cut more slices from the same pizza to accommodate everyone. Even if the pizza itself is getting larger, your original slice, representing your ownership stake, becomes smaller. Similarly, when a company issues new shares, even if the company is growing, each existing shareholder now owns a smaller percentage of that larger entity. The hidden cost here is that investors might celebrate a rising stock price, oblivious to the simultaneous increase in the number of shares outstanding. This growing supply of shares can dilute the value of each individual share, effectively eroding the gains that appear on paper. A rising stock price might be masked by a rapidly expanding share count, meaning your actual proportional ownership and the intrinsic value per share could be diminishing. Therefore, it's imperative to monitor a company's share count over time. Be particularly wary of companies that consistently issue new stock to fund their day-to-day operations or even acquisitions, especially if there isn't a clear, value-accretive strategy behind these issuances. This practice can act as a hidden tax on long-term shareholders, subtly diminishing their stake. Understanding the true cost of capital for these growth companies and recognizing how dilution can quietly sabotage your investment is a critical piece of forensic accounting for any discerning discerning investor. We've journeyed through the treacherous terrain of growth stock chasing, uncovering 5 common traps that can lead even the most ambitious investors down a path of portfolio destruction. We've seen how the Greater Fool Valuation can turn a promising company into a speculative gamble, how the illusion of unstoppable momentum blinds us to cyclical realities, and how profitless prosperity disguises fundamental weakness. We've also examined the seductive power of management overpromisitis and the insidious impact of the dilution dance on shareholder value. These traps are not mere academic concepts. They are the very real pitfalls that have cost countless investors dearly. They prey on our emotions, our desire for quick gains, our fear of missing out, our misplaced faith. To navigate these waters successfully, a healthy dose of skepticism, coupled with a rigorous, data-driven approach, is not just advisable, it is essential. We must always focus on intrinsic value, on the enduring strength of sustainable business models, rather than being swayed by the ephemeral allure of the latest market darling. As Warren Buffett wisely put it, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. True, sustainable growth is not found in stocks that merely fly high on hype. It is cultivated within wonderful businesses that possess durable competitive advantages and a clear path to consistent profitability. These are the companies that can weather economic storms and deliver long-term value. So, I encourage you to take these analytical frameworks and apply them diligently to your own investment decisions. Conduct your research with a discerning eye. Prioritize long-term value over the siren song of short-term speculation. Remember, true wealth building is not about predicting the next big thing. It is about making informed, disciplined decisions. It is about becoming a prudent investor, not merely a speculator caught in the fleeting winds of market trends. Your portfolio's resilience and your financial future depend on it.